Let me get started with gold. So if you're bullish on gold, what's the best way to get exposure to the metal? Are we talking ETFs? Are we talking about the real bullion, miners, a mix?
Well, the most convenient way to do it is through an ETF. You don't have the inconvenience of owning the bullion and worrying about storing it and having it move from place to place. Bullion is, great, but how do you store it and how do you hide it under a mattress? No, it's ETF. It's a financial instrument that provides you convenience by not having to deal with the physical material.
So, Ed, a few of the elements that seem to be boosting bullion also seem to be helping silver as well. But in fact, when it comes to silver, how much of the industrial demand rebound optimism is playing into it as well?
It plays to it. So, silver is the poor man's or poor woman's gold. So there's an element of all of those other things that go into the gold market, the depreciation of the dollar against other currencies, continued world of high risk and low interest rates. But in addition to that, you have the industrial uses of silver, in particular in photovoltaic cells, and that boost should really change the relationship between silver and gold. So in terms of looking at the next year or two, we think you got a combination of factors: the underlying factors that are boosting gold and silver, and the industrial factors that should change the ratio between silver and gold.
So I have to ask the age-old question right now, given the unprecedented year that is 2020, do we look at gold as a commodity or as a currency? What do you advise investors to kind of, shift their perspective into?
So we have never actually thought of thinking of gold as a commodity. It's not like other commodities. It's not consumable. You never really lose the store of gold in the world. It is more like a currency. It's more like an asset that fluctuates with a lot of other things. And this is kind of moment where gold really works in terms of the yield that you can get from it based on all other things that are happening in the global economy. You don't have to worry about deterioration, consumption. It is something unlike other commodities, which gives you a sense of where the world is going rather than a snapshot of the world is currently.
Is the momentum and bullishness that we're seeing for the outlook for gold unprecedented to you, or is it comparable to any other period of financial history in your experience?
It's comparable to other periods. We have a couple of unique things happening. If you look at the price of gold in a whole bunch of currencies other than the US dollar, it has never been dearer than it currently is. If you look at the nature of the world we're living in, we're going through a critical environment that can be compared to something so far worse than the great financial crisis, when gold ETFs came into being in a big way for investors. And it's on the dangerous precipice of being something like the Great Depression, 28 to 32. So yeah, there is something unique about it, although we've seen the play in gold in 2008-9. We saw the play in gold in 2016, but this is, in terms of risk in the global system, something that nobody living today as an adult has ever seen before.
So you're pretty bullish on precious metals. What would actually make you change your stance, if at all? What elements would you take into account?
I think the biggest one would be if there really were an inflation rising in the world economy somewhere. You can think about inflation in terms of food and fuel. We have, just in the US, a very limited, in terms of recent history, amount of acreage under cultivation. We have very adverse weather conditions. And if you look at the main food staples, soybeans, wheat, and corn, they look like they could be inflationary, and with the dollar depreciation, inflationary across other countries. And similarly with energy. So it's food and fuel that lead inflation, and reflation could be a damper, it could be a headwind. So that's the biggest risk, and we don't think it's a huge one.
When you're taking a look at energy prices and you see oil and gas prices strengthening over the next 2 years, will oil companies eventually bring back spending on upstream, or will investors and also bank concerns about climate change and so forth hold capex back?
Well, there are a whole bunch of things that are happening. And yes, the investor community is wary for climate change reasons about hydrocarbons in general. We think it's more complicated than that. To begin with, we have to look at the efficiency of capital rather than the total amount of capital being spent. On the efficiency of capital, just 5 years ago, 7 years ago, the average cost of finding and developing a barrel of oil was $30 a barrel. In the last 3 years through 2019, it was under $15 a barrel with downward momentum. So a dollar spent has twice the amount of efficiency as it had a half decade or so ago. And people tend to forget about that when they look at the gross amount of capital being spent on it. The other thing is the cost curve for oil, which has flattened tremendously. And I think we have to remember this, for 160 years, most of the oil and gas that was exploited in the world came from reservoirs, pockets of accumulated material in a reservoir. The technological revolution of the last decade was to go beyond reservoirs and to look at source rock, and then with new technology to bring the cost down tremendously. And in fact, if you look at that reduction from $30 to $13 a barrel in the period 2012, 13, 14 to 2019, it really meant that the lead, other than in some parts of the Middle East, on low-cost material was in rock, in shale rock. And this is novel. It means that at a price under $50 a barrel, you can probably grow oil production over a 5-year period of time at 18 million barrels a day, which is going to be greater than what oil demand is. So that's one factor. Another factor is that we want to find a world which is less carbon intensive, less methane intensive. That world requires pricing carbon. We're seeing carbon being priced in an adequate way these days in Europe due to the carbon pricing system in Europe. We see it in California. We see it in the RGGI system in the eastern part of the US. The world really needs this carbon price in order to get investment, pricing carbon in order to get rid of it. We have technologies that can be developed as long as it's a price of carbon, which enables financial markets to invest in decarbonizing the planet. And you can have companies big and small, whether it's Shell, BP, Exxon, and the like, or smaller ones where if they have the technology to decarbonize and to invest in various processes, and there are dozens of different processes to reduce carbon, then we can have transportation fuels that are based on the hydrocarbon while reducing the carbon element of it. So it's not the end of big oil or small oil. There are many factors at work. And yes, COVID and its epidemic has spurred on both regulation, as in Europe in particular, and spurred on investment to reduce oil as a transport fuel and to reduce coal and to some degree natural gas as a power generating fuel. But they're not going to go away for the next 30 years.